Welcome to The Explainer. Today, we're going to break down how you can really understand what a company is worth. We're going to cover the tools, the frameworks, and most importantly, the mindsets that can take you from just another investor to someone who can truly size up any business.
Okay, so let's just dive right in. What's the secret sauce? What do the best investors on the planet see that the rest of us miss? Is it some secret, hidden information, or is it just a totally different way of thinking? Well, the truth is it's kind of both. It's all about asking the right questions and knowing exactly where to look for the answers.
You know that feeling? When you're trying to research a company and it just feels like the really good stuff, the truly insightful information is locked away somewhere, like it's just out of reach. That's where our journey begins.
And look at this, someone on Reddit just nailed it. This feeling is the starting point for so many people who want to get serious about this stuff. It's that nagging sense that you're missing a key piece of the puzzle. But what if I told you you're not?
So here's the secret. There is no secret. The pros aren't using some secret handshake to get inside info. You know those glossy reports from big institutions? A lot of the time, they're just glorified sales pitches. The real work, the real edge, comes from digging into the primary sources that are out there for everyone. SEC filings, earnings call transcripts, annual reports. The advantage isn't access. It's the willingness to actually do the work.
Okay, so you've got all this information. Now what? You can't just stare at a pile of data. You need a way to make sense of it all. You need a framework. And this is where the real art and science of analysis comes into play. First up, you've got the quantitative lens. Think of this as the science. It's all about the numbers, the stuff you can measure. Financial ratios, stock prices, earnings reports. It's objective, it's data-driven, and it gives you a rock-solid foundation.
But then, there's the other lens, the qualitative one. This is the art. This is the story behind the numbers. The quality of the management team, the strength of the brand, the company culture, all the crucial, intangible stuff that can absolutely make or break a business.
And this table just lays it out perfectly, right? The quantitative gives you the what, the hard numbers, the precise results. But the qualitative, that gives you the why. It's the rich, contextual insight into everything else. It's like one gives you the skeleton, but the other gives you the soul.
So that's the big question, isn't it? If you had to pick one, which lens should you be looking through? The objective, cold, hard science, or the subjective, nuanced art?
Well, here's the thing. It's a trick question. The best in the world, they don't choose. They use both. They integrate that objective data with a deep, contextual understanding of the story. It is the only way to see the full, complete picture of what a company is truly worth.
All right, let's take this a step further, because it's one thing to analyze a company from the outside, but it's another thing entirely to understand how the absolute best leaders actively create value from the inside. This is next level.
There's this fantastic book called The Outsiders, and it found something incredible. The truly legendary CEOs, they think about their job in a fundamentally different way. They believe their main job isn't just running the day-to-day business. It's deciding where to invest the cash the business generates. They are investors, first and foremost.
Think about it. When a company makes a profit, the CEO basically has 5 places they can put that cash. They can reinvest it back into the business. They can go out and acquire other companies. They can pay it out to shareholders as a dividend. They can pay down debt, or they can buy back their own company's stock. Every choice is a fork in the road, and the path they choose is what separates the good from the truly great. And what's wild is that the author found this clear, repeatable pattern. These outsider CEOs consistently picked the options that gave the best return to their shareholders. They would aggressively buy back stock when it was cheap, they'd make big, smart acquisitions, and they actively avoided things like paying dividends, which they saw as inefficient from a tax perspective.
So you see the difference here? It's a totally different mindset. The outsider CEO is obsessed with rational, per-share value for the owner. The conventional CEO, they're often driven by ego, by what their peers are doing, by the desire to build a bigger empire, even if it's not the best move for investors.
And the result of this kind of disciplined investor-first thinking? Well, it's just staggering. From 1965 to 2011, Warren Buffett's Berkshire Hathaway, which is the prime example of this philosophy, outperformed the S&P 500 by, wait for it, 100 times. Yeah, not a typo. 100x. That is the power of rational capital allocation.
Okay, so we've seen how value is created, but to really get the full picture,
we have to look at the dark side, how value gets absolutely destroyed.
You know, learning from failure is huge, and the data here is so telling. Most startups don't fail because of some single dramatic event. They fail because of fundamental flaws. And look at that top reason. A whopping 42% fail because of no market need. They built something nobody actually wanted.
Let's look at a classic cautionary tale. Webvan. You might remember them from the dot-com bust. A huge idea that was, well, just way too early.
They heard what you could call the siren song of optimism. They got so excited about the idea of online grocery delivery that they invested billions, literally billions, in massive automated warehouses and a whole fleet of trucks. The problem? They built it all before they really confirmed if customers wanted the service at that scale. They burned through all their cash before they got the answer.
Or how about a more recent one? Remember Juicero? The super high-tech juicer that became a total punchline in Silicon Valley.
This is a textbook case of what we could call the abyss of arrogance. They built this beautifully engineered $400 Wi-Fi connected machine to squeeze a proprietary bag of juice. The fatal flaw they ignored? You could get the exact same result just as fast by squeezing the bag with your own two hands. It became the ultimate symbol of solving a problem that never existed.
So when it all goes wrong, when a company fails and all that potential value just evaporates, what's left? What's the absolute bottom of the barrel value? That's what we call liquidation value. It's what the company's desks, computers, and warehouses are worth if you sell them all off.
And even here, at the bitter end, there's a huge difference. An orderly liquidation means you sell things off smartly, over time, to try and get the best price possible. But a forced liquidation, that's a fire sale, a panic. It's everything must go now, usually for pennies on the dollar. It's the final, desperate act.
So this all brings us to one last big question for you to think about. A company's story is told through its numbers and its narratives, for sure. But its ultimate value, whether it grows into something amazing or disappears completely, so often comes down to the rational or irrational decisions of the person at the very top. So the real question is, are you just analyzing the business or are you analyzing the person running it?